Welcome to today's show. I'm with Robert Zuccaro. And Robert, welcome.
Thank you. Glad to be here.
So, Robert, you have a very unique background focus in the investment arena. And for the listeners here, can you tell us your pathway of how you got to where you are today and how Target QR came about?
Okay. The path I've taken is very long and very circuitous. I started as a money manager in 1978, running the Axe Houghton stock fund. I ran that fund for 6 years. And when I arrived at Axe Houghton, I was hired as an analyst in 1976. And then in 1977, not a single equities account was doing better than the S&P 500. So I had distinguished myself in my short time there as an analyst, and I was asked to work on the stock fund. In 1978, I was assigned full responsibility for the stock fund, but I had an inherent problem. Our portfolio managers were buying off a buy list prepared by the research department, and this was not working. So I undertook an examination of every recommendation that was made by our 8-man analyst group over the previous 5 years, and not to my surprise, the recommendations that they were making was not helpful. I already knew this, but I needed to document it. So I decided to become a quant even before the term was coined. And in the early days, what I did is I would buy the fastest growth rates with the lowest PE. For example, if two stocks are growing their earnings by 40%, one selling at a 30 PE, the other selling at a 20 PE, I would buy the lower PE stock. This worked. As time went by, I incorporated positive earnings surprise work into the management of my fund. And in 1978, when I started managing the stock fund, it was 10 years before the first quant fund was introduced by Morgan Stanley in 1988. The stock fund beat the S&P for 6 straight years, culminating with 118% return in my final year. I had a lot of job offers, and I never really had expectations of starting an advisory firm, but I decided, well, if there's this much interest in me, I'll take a shot at it. I founded Target Investors in 1984 as a small growth stock manager. We built a very sizable institutional base. And then in 1998, we decided to enter the mutual fund market with our first fund, Grand Prix Fund. Grand Prix Fund went on to beat the vast majority of funds, posting 112% return in 1998, followed by another triple-digit return of 147% in 1999. Then the severe bear market of 2000-2003 affected the investment business. In that bear market, the NASDAQ dropped by a record-setting 78%. The S&P was down 52%. And as a quant manager, also as a momentum manager, most of these funds disappeared during that severe bear market. I continued to do my research and run the remaining assets and closed this business in 2005, moving to a family office and also continuing my research, which I have always felt has been quite valuable. In 2014, I decided that the only way to benefit from my research on a monetary basis was to offer another fund. So I went into I formed the firm Target QR Strategies to go into the hedge fund business for 2 reasons. Number one, to monetize my research. Number two, I always felt that the hedge fund business is very easy to compete in because the vast majority of hedge funds substantially underperform the market. We started with our first hedge fund, which did very well in its second year, but in the third year was not tracking against its model, which we had built. We realized that after 3 years had gone by and the fund was not tracking his model, that we had a flawed database, so we had to go back to square one and start over. We introduced quarter horse with an annualized rate of return of 30% over the 10-year model life. This was a lot higher than my actual track record compiled over 28 years that shows a 20.4% annualized rate of return. The best performing fund over that same period returned 18.7%. So coming back to quarter horse, we had a very good model on its hands. 2 years ago, I was struck by a lightning bolt. And during the Democratic primaries, the proposal was made to tax securities transactions at the rate of 0.5%. Quarter horse had very high turnover. As a momentum fund, its portfolio was rebalanced twice a month or 24 times a year. Any type of legislation to that effect would literally put quarter horse out of business. So once again, we had to go back to the drawing board. And there's a study that I've done. I've done a multitude of studies. I regard myself as 95% analyst, 5% portfolio manager, and I fervently believe that in order to be successful as a portfolio manager, you have to be first and foremost an analyst. So I looked at my analytical work for the years 1985 through the year 2000 at stocks which improved their earnings by at least 20%. These stocks on average returned 62%. For the first time, 20 years later, I segmented this earnings growth and found that companies which improved their earnings by 51% or more averaged a price gain of 104%, which gave birth to our current fund, Golden Eagle Growth Fund. Now, in the Golden Eagle strategy, we try to identify 25 of the world's fastest growing companies using quantitative disciplines. We have 8 screens. Within the 8 screens are 12 metrics that have to be met or exceeded. We measure, our primary screens are built on 2 broad metrics. One is earnings growth, and the other is new high stock history. We've done a lot of work on new high stocks and have built a data bank comprised by 34,232 new high stocks with accumulated data over an 18-year period. What our work shows is that new high stocks display predictive price patterns. Typically what happens is a stock setting a first new high will often go on to record 25 additional new highs. And that's what our process is capturing, the additional new highs, of which there are very many. The strategy has proved very good over the past year. In its first year of operation, Golden Eagle is up 121%. Year to date, in the first 4 weeks, it's up double digits once again. And I have to comment on a model going back 10 years. It's built on a model that has outperformed the S&P in 9 of 10 years and posted double-digit returns in all 10 years. So the fund is actually tracking ahead of its model because we never actively managed the model because we didn't have the capability of making changes based on changing data every week, every day of the week. The fund last year significantly outperformed its model because it's actively managed, where the model years were frozen at year end and the fund was recast once a year. That's where we are today, Alan.
Well, with all this experience that you have of following Wall Street, you were inspired to write a book, How Wall Street Shaped America's Destiny. What made you decide to write that book?
Well, do you recall the Occupy Wall Street movement of years ago? Not one of these people that were sitting in had any idea what Wall Street was about and how Wall Street has benefited this country in so many ways. Without Wall Street, the United States would not have led the Industrial Revolution. Without Wall Street, the United States would not have won 2 world wars. We entered World War I in 1917. The war started in 1914 when the Archduke of Austria was assassinated in Serbia. During that 3-year hiatus before we entered the war, the great investment banks like Kidder Peabody and Seligman and Morgan Stanley were financing the Allies. Most investors don't understand this. And what's particularly interesting is that there is not a city or state in this country today that could provide the services and products that they do without Wall Street, because Wall Street is constantly financing their deficit funding habits.
How did Wall Street come about?
It came about in 1792 when a group of brokers got together literally under a buttonwood tree in Manhattan, and they created an agreement whereby they were creating securities. It took about 20 years for the securities business to grow to a point where they can occupy a building on Wall Street. The business picked up very dramatically in the 1820s with the Canal Era. The Canal Era was very important in that before, products used to be shipped overland from the Midwest to New York City. With the opening of the Erie Canal, which was financed by the federal government, it reduced shipping times by 60% and shipping costs by 90%, making New York the center of not only commerce, but finance in the United States. Prior to that, Philadelphia was the kingpin in both finance and commerce. Wall Street has continued to grow for many years. In the 1940s, the railroad, which could connect markets overland, all destinations, as opposed to the canals, which were dependent upon water, enough water. Canals went through droughts, they didn't have enough water, but the railroads obsoleted the canals, and for during the 1800s, the railroads dominated both the U.S. economy and the U.S. stock market. At this point in time, technology is doing that with its growing influence over both the economy and stock market.
You know, if Wall Street hadn't happened, what do you think the U.S. would look like?
I think we'd probably be under dictatorship or a socialist economy because government would be in total control of everything. And what's difference? The difference between government and private enterprise is vast. Private enterprise operates on a profit system. They are motivated to bring new products and services out, whereas government is stuck in its old habits and embroiled in politics. Without business today, our standard of living would not be what it is.
You know, this book, I'm excited. I got my copy last week, and you're just beginning to roll this out on Amazon.
Yeah, it should be available in the next couple of weeks on Amazon.
All right.
Our editor reviewed the book, and he had nice things to say. Now, I don't know if he was being nice or being genuine, but he said that the book would have widespread appeal. And I really think something like this should be taught in the schools. You'll be surprised by this, Alan, but this is the only compendium on 200 years of Wall Street history. I couldn't find anything else other than specific incidents like the Great Depression, the Panic of 1906, the Panic of 1853. But this is a compendium on 200 years of Wall Street history.
You know, the timing of this is very interesting. Of course, we just changed an administration over, and also we're getting ready for another 1.9 trillion stimulus package. How do you think this all this printing of money is affecting the market?
I'd say right now it's making the market go up because it's stimulus. But at some point, we're going to have to pay the piper with all this debt. We are now over $30 trillion of debt. At the end of 2000, we had $5 trillion of debt. And unfortunately, the mindset in this country has developed. It's good to sell debt because interest rates are low. Everybody is taking their eye off the ball. If interest rates go back to their normalized level of 4.5% on long government bonds, interest costs on the national debt are going to consume half of the federal budget. And you know what that means for other services that the federal government provides. They're going to have to be dramatically cut. We're not going to have a problem for 5 or 10 years, but over the near term, the economy is going to be stimulated. We are only into the first year of a bull market. Bull markets typically last 4 to 5 years. So there's a lot more upside to come near term in this market advancement.
You mentioned something about moving from 5 trillion to 30 trillion in debt. And I missed the time frame again. What was that time frame going from 5 trillion to 30?
Over a short period of 20 years. It's a staggering number. And unfortunately, the people who run the country are learned in politics, knowing very little about economics, and they are making major economic systems decisions. The United States is the biggest business in the world, and it's not being run in a business-like way.
Put it in perspective, I once did a little study on how long, if you counted to a billion, 1, 2, 3, how many years it would take? It takes 37 years. If you count to a trillion, it takes it's in excess of 37,000 years. Which
look at it this way. It took us 128 years to create debt of 5 trillion. We've created 25 trillion debts in 20 years. Do you see the trajectory? Straight up.
Exponential growth and of the debt. Now, I've once heard, though, that the way to retire all of our debt is to monetize or inflate the dollar value. But I don't know. What's your thoughts on people that have that line of thinking?
Well, ultimately, benefits for everybody are going to have to be cut: education, Social Security, Medicare, Medicaid. There's no way out of this. If you recall the bust of 2008, which was viewed as a Great Recession, Ireland did something that no other country did. A year later, they reduced government spending by 21% and they reduced pension payouts by 22%. 3 years later, their economy was growing at a 20% rate. We'll probably have to go through the same exercise.
So let's look forward now. So here we are today. We're looking into the second year of a bull market. And what would you do? How would you advise people looking forward how to move forward? And also, I think we still have COVID in the air too. So
yeah,
what would be the short term versus the long term here?
Yeah, we'll focus on the short term. COVID is a near-term problem. Hopefully this year it's behind us. There are a couple of reports on my desk. One states that the stock market's overvalued by 77%. The other one states that the stock market is more overvalued at any time since 1950 based upon 8 ratios. Among them are price to earnings, price to book, price to sales. In 1980, if you assume that the stock market was undervalued at 10 times earnings, you were right, because the market went up 265% over the next 10 years. Today, the stock market's selling at a 23 PE. Most forecasts say that the stock market is overvalued. If you assume that the stock market is overvalued today, you'll probably be wrong. Here's why. In 1980, there was one technology stock among the top 5 in the S&P 500. It was IBM, which represented 2% of overall index weight. Today, the top 5 stocks in the S&P 500 are all tech stocks for the first time. These companies command an unprecedented weight of 23% of the index weight. How did these 5 stocks do in the pandemic third quarter? They increased their earnings by an average of 60%, whereas the other 495 companies in the index saw their earnings plummet by 61%. So I would argue that we are in an era of permanently high PE stocks due to the growing influence of technology on both the economy and the stock market. So I would hang around for the next 4 years. There's another report that came across my desk. I had to laugh at this one today by KCI Research. They said you ought to sell your stocks and be out of the market for the next 7 years. Every study shows that investors hurt themselves time again when they get out of the market, only to find that they get back in at much higher levels. So I'm optimistic about the economic rebound that we are going to have worldwide, which should be V-shaped if you're into the alphabet, and should endure for a few years more.
So Biden administration coming in, how will they affect Wall Street?
They won't affect Wall Street. Let's look at the vaccine. We have 2 companies that I'm aware of, one in Germany. You have Moderna and Pfizer in the span of 9 months that have brought vaccines to the market. Business is going to go about its business irrespective of any administration, irrespective of high inflation, low inflation, high interest rates, low interest rates, strong dollar, weak dollar, adjusting to all the circumstances in order to improve corporate profits, introducing new and better products which enhance the American way of life.
You know, it's interesting. I guess I love the piece about don't time the market. Also, that the piper must be paid because 30 trillion of debt is not going away. In your fund strategy right now, let's talk about a person that says, "Hey, Robert, we believe in what you're doing. How do we join you? How do we become part of your fund?"
Well, I'd say the first thing you do is go to our website, review it. There are a lot of studies which will help to inform the investor, not only on us, but on the stock market as a whole. One of the things I try and do as a money manager is to educate the investing public. It's one reason why I had that book published, and it's a reason why my research is never ending. So I would say start by going to targetqr.com.
Great things. I've been visiting here today with Robert Zuccaro. We've been talking about his book, How Wall Street Reshaped America's Destiny. Robert, thanks for being with us today. You can pick up his book on Amazon. And any final words before we depart?
I would say, if you own stocks, never sell your stocks, because you only sell stocks when newspaper headlines are read the worst. And right now, they're just about every forecast saying that stock market's overvalued. Forecasting is a very perilous business. Somebody once said, give them a number or a date, not both at once.
All right. Thanks for being with us today, Robert.
Thank you, Alan.